If you only looked at the headlines, you'd think that Canada's housing market is finally healing. Prices are easing, interest rates have come down, and rents in some cities are starting to fall. But when you actually dig into the data, 2025 starts to look like one of the strangest and most contradictory housing years that Canada has seen in decades. We saw sales collapse to levels not seen in over 20 years, listings explode to record highs, and at the same time, Canada experienced a rare population decline driven almost entirely by policy. And yet prices in markets like Vancouver are still sitting over $1 million. So today I wanted to walk through what really happened in the 2025 housing market, why the numbers feel so disconnected from everyday reality, and what this sets us up for as we head into 2026. When you zoom in on Greater Vancouver, this contradiction becomes very clear. One of the defining features in the 2025 market was this growing gulf between buyers and sellers. Residential sales totaled just under 23,800 for the year, making it the weakest annual sales total in more than 2 decades and roughly 25% below the 10-year average. At the same time, sellers flooded the market. More than 65,000 properties were listed in 2025, breaking the previous record that had been set during the 2008 financial crisis. So you have buyer demand at a 20-year low, and then you have listing supply at a roughly 30-year high. On paper, that sounds like a setup for prices to collapse, but that's not exactly what happened. The benchmark price in Greater Vancouver ended the year at around 1.11 million, down 4.5% year over year. That decline is real, but it's far from a free fall. This is where price stickiness matters. In large urban markets, prices tend to adjust slowly. Sellers are often reluctant to accept large losses. Some pull listings entirely, and price discovery takes time. Demand doesn't disappear completely. It just becomes more selective. That's why one of the most important indicators to watch is the sales to active listings ratio. Historically, when that ratio stays below 12%, prices come under sustained downward pressure. In December, Vancouver sat at roughly 12.7%, right on the edge, and you can already see the broad-based softening. Detached homes were down just over 5% year over year. Apartments were also down around 5%, and townhomes also declined by around 5%. This isn't isolated to one segment. It's happening across the board. For buyers, this means more choice, more leverage, and borrowing costs that are now almost a full point lower than when they were at the peak. According to the GVR's chief economist, buyers are entering 2026 with some of the best conditions they've seen in years. But this local cooling is tied to a much bigger shift happening across the entire country. For years, Canada's housing market was fueled by extraordinary population growth. That was the backbone of demand. In 2025, that story changed in a meaningful way. In the third quarter of last year, both Ontario and British Columbia recorded population declines, falling by about 0.4% and 0.3% respectively in that single quarter. This was driven by an overwhelmingly sharp drop in non-permanent residents. Roughly 340,000 non-PRs left Canada in 2025, the largest quarterly decline since comparable records began. Statistics Canada has been clear that this outflow was the primary reason population growth turned negative. This wasn't a short-term fluctuation. It was a result of deliberate policy shifts aimed at reducing temporary residents. At the same time, something else unusual was happening. Canadian citizens and permanent residents were also leaving the country at one of the fastest paces on record, with more than 41,000 emigrating in one single quarter. So demand was being reduced from multiple angles, and construction responded quickly. Housing starts for homes intended for ownership fell sharply as developers pulled back in response to weaker demand. But rental construction surged. CMHC data shows that rental housing starts reached a record high pace in 2025 and began outpacing starts for owner-occupied housing. Over the past year, rental construction accelerated rapidly as developers chased the only segment still supported by financing and policy incentives. When you combine shrinking renter population with a massive surge in rental supply, the result is pretty predictable. Rental markets soften, incentives increase, and rents come under further pressure. You can already see this stress clearly in Toronto's condo market. New condo apartment sales collapsed to just under 165 units in November, a 96% drop from the peak in 2021. At the same time, CMHC reports that completed but unabsorbed new housing inventory across major Canadian markets rose by roughly 184,000 units by late 2025. That's a record amount of newly built supply sitting unsold. And it's one of the main reasons new construction has slowed so dramatically. So, what does all of this mean if you're trying to make sense of the market and plan for 2026? There is a long-term reality worth acknowledging without overstating it. Over time, homeowners tend to accumulate significantly more wealth than renters, largely because housing acts as a forced saving mechanism. That gap still exists. But also, that doesn't mean rushing into a bad purchase in today's environment makes sense. In the short term, the market is increasingly rewarding patience, and that brings us to 2026. If I had to describe my prediction for 2026 in one word, it would be uncertainty. We're heading into a year with unresolved trade tariff and uncertainty with the United States, which matters enormously for Canada's economy. Interest rates are lower than they were, but still high enough to suppress demand. Population growth, which masked imbalances for years, is now moving in reverse. Add ongoing land claims, regulatory uncertainty, and political pressure around housing, and you get an environment where confidence weakens. And when confidence fades, people delay big decisions. Uncertainty doesn't usually crash housing markets, but it does slow them. That's why my base case for 2026 is a quiet year. I expect sales volumes to remain weak, activity to stay subdued, and prices to continue drifting lower in most provinces, not collapsing, but gradually softening. In other words, 2026 doesn't look like a rebound year to me. It looks like a year of digestion. Given all this context and where the market appears to be heading for 2026, strategy matters more than ever, especially if you're thinking about selling. This is not a one-size-fits-all market. Every area is behaving differently, and each of the three main property types, detached homes, townhouses, and condos, has its own supply and demand dynamics right now. Pricing has to be bang on, and you need the marketing to support it. In a market with this much selection, a lot of buyers will be able to spot when something is off. For buyers, my advice is to get out there and start looking. I'm not saying rush out and buy a home tomorrow. What I am saying is that there's more inventory than we've seen in years. And this is an opportunity to actually understand the market again. Go see homes, learn what you like, learn what you don't, and pay close attention to how each property feels when you're inside them. That knowledge can become a real advantage when the right opportunity shows up. And if you want to understand how the current market affects your situation, whether you're buying or selling or just looking to plan ahead, there's a Calendly link below. We can go through it together and figure out what makes the most sense for you and your situation. So to wrap this up, 2025 was a year of contradictions. Prices eased, inventory surged, and sales collapsed, all while Canada experienced a rare population decline and a massive shift towards rental construction. As we move into 2026, renters will likely hold the short-term advantage. Rents are softening, incentives are rising, and uncertainty is keeping buyers cautious. But the affordability crisis hasn't disappeared. Mortgage renewals remain a risk, and some homeowners could see a significant increase in their monthly costs. Ownership costs are still elevated, and long-term math continues to favor ownership. That's the paradox. The short-term market rewards patience. The long-term market math still rewards ownership. And in my opinion, navigating that tension is going to define the housing market for 2026.